You're able to
Yeah,
figure
sure.
that out.
Yeah.
Okay.
Okay,
Um,
Karen.
so what's in a credit score? You see three credit scores on a credit report. So when Lauri pulls that credit report, there's three scores on there. But why is that? Why are they three different scores? And there's two main reasons. One is different information um, gets reported to different credit bureaus. So for example, a medical collection might report to TransUnion, whereas another one might end up reporting to all three. So, um, and then also you might have like credit cards where you have different balances that report to different credit bureaus because they report to different credit bureaus on different days of the month. And we'll talk here in a little bit why balances on credit cards, how that can impact the credit scores. But the main reason really is algorithms, which is an algorithm is a fancy word for a mathematical formula. And that's what's used to compute the credit score. So, but let's talk a little bit more about algorithms. And there's over 100 different ways to compute a credit score across several different industries. The and there's different methodologies for doing that. You have FICO being the main one, but there's also something called Vantage, and Vantage came about from the three credit bureaus got together back in 2006, and they said, "Hey, let's put together a whole new way of doing credit scoring," and they came up with the Vantage model. And it had a range from like a 500 to a 990, whereas the FICO was from a 300 to an 850. So it was quite a bit of difference. And you would see sometimes score differences of as much as 150 points difference in, say, like a mortgage FICO score. But there's been a few different iterations since. Right now, we're on the third iteration of Vantage 3.0, and that Vantage 3.0 is a lot closer to a mortgage FICO score, but is usually typically still higher than a mortgage FICO score. And we're going to talk more about mortgage FICO and the breakdown of the model. But in Vantage, there's like 7 different pieces, whereas mortgage FICO, there's 5. So that's one of the main reasons why you see those differences.
Yeah.
Oh, I see Lauri's face. Hi.
I got it. I got it. Finally. I've been sorry. I was studying on what was wrong on the other, but I was listening to you.
And by the way, Susan, I did it.
All right.
I found it.
Yeah.
If nothing else happens today, we're figuring out.
We're all good now.
Good.
Figuring out the technology.
Yeah.
I know. It's crazy. Hilarious. Okay, go ahead. Sorry.
But what is FICO? So FICO is really the law of the land for any type of loan that's going to happen. It's going to happen using a FICO-based algorithm. Now, FICO stands for Fair Isaac Corporation. Now, where does it come from? There were two guys that got together back in the 60s, Mr. Fair and Mr. Isaac, and they said, hey, let's come up with a way, a mathematical formula that can be used by banks where they can determine, is this person going to be likely to pay a loan back? So, and that's where that credit score came from. And that's where because it stands for Fair Isaac Corporation. So FICO, that's where that comes from. And it was eventually adopted by banks, credit card companies, other users. And then in the 80s, I don't know the exact date, but sometime in the 80s, it was adopted by the mortgage industry. Prior to that, mortgages were all done basically, a huge manual underwrite where you brought in shoe boxes of stuff and they looked at everything, and that's how a mortgage was done prior to mortgage scoring. Now, in FICO, there's 49 different ways to compute a FICO score. Now, a lot of times people will pick up their phone and they'll look at it and they'll say, okay, here's my credit score. And sometimes that can be that it could be a Vantage score that you're seeing on your phone. In other cases, it can be something like a FICO score. But even the FICO scores that you see on your phone or online are not the same FICO scores that Lauri is going to pull. Okay, so that's where you have the mortgage FICO scores. It's still a FICO score, but it's a subset of them that are specific to the mortgage industry. There's 9 of them that have been approved by Fannie Mae and Freddie Mac for use in the mortgage industry. There are 3 of them that are primarily used today. Now, when I first got in the business, it wasn't quite like that. There was probably like 5 or 6 of them, different ones that were used. You could actually go to Lauri and have your credit pulled, and then go down the street to Wells Fargo and have your credit pulled, and you would see, 2 different credit scores, even if they were pulled on the same day. That's not the case today. And it's really because the investors, the people that buy the loans, have dictated, hey, we're not going to buy the loan unless these specific algorithms are being used. And it's Beacon 5.0, Classic 04, and Fair Isaac version 2. So when Lauri pulls a credit report, you will actually see the name of those algorithms listed on the credit report, okay? And they do that, I don't know if it's a law or something, but I'm sure it's a rule somewhere that says they have to be listed, so you know. But then, and most importantly, the investors know when they go to buy the loan that, okay, this was all done correctly. But just so you know, the mortgage industry will have the lowest subset of scores of any other industry when it comes to credit scoring. So if you are comparing your mortgage credit score to anything else, and that includes your online scores, your auto scores, what have you, it's going to be different, and it's going to be, sometimes 30 to 40 points different. So if you go buy a car and apply for a mortgage on the same day, you might be like, hey, what's gives? I was a 640 over here buying this car, and now you're telling me I'm a 593. I don't get it. Well, and that's because there's a big difference, and sometimes it could be as much as 50 points difference between like auto and mortgage. Okay.
I like how the mortgage company gets blamed for that.
Exactly. And
I have a question though.
Mortgage. Yeah, go ahead.
How does that relate to like the Experian? They send you your score once a month, the Experian score.
Yeah, so the Experian. Yeah, that's a great question. So Experian sometimes has 2 different ones. So now Experian was actually the spearhead behind Vantage. A lot of times Experian is going to send you a Vantage score unless you're paying specifically for their program that sends you a FICO. And I think it might be a little bit more expensive to send you a FICO. But if there's one that you're in that's cheaper or free, then they'll send you probably their Vantage score. And it's a Vantage, you just need to look at it as kind of like a consumer score. It's not a real lender-based credit score. I don't like to use the word, it's not a real credit score, because it is. It's still a determination of your ability to pay things back, but it's just not anything that a lender is going to use. But it still can, and we have all of our clients sign up for something called Identity IQ. We'll talk about that a little bit later on with credit monitoring, but we have all of our clients sign up for that. And it is a Vantage score, but we know beforehand what we're dealing with, and we're looking for a trend. So if you're tracking your scores and you see your scores are going up, well, then that's a good thing, okay? Whether it be a Vantage score or a FICO score, and the 2 are usually going to correlate as far as, things that you're doing are going to correlate from one to the other. There might be a few exceptions to that, but for the most part, there is a correlation there. So now we're going to let Susan talk about payment history and kind of talk a little bit about the breakdown here.
Yeah, one thing I wanted to mention, Chris, I don't know if you talked about when you talked about why scores are so different, about credit card reporting on different days of the month. And this is one thing that we try to help people understand too, when why their scores fluctuate so much. So credit cards, when you look at the days of the month that they report, they might report to Equifax on the 1st of the month, the data about your credit card, about your balance and the limit, but then they might report to to TransUnion and Experian on a different day. So it's usually as Equifax is the 1st and TransUnion and Experian is on a different day, and it's kind of random. Sometimes it's the 18th or the 27th or the 4th, or so whatever snapshot that they send on that day is what credit score is kind of generated for that card towards your score. And if you're using your card, kind of charging it up and paying it down and charging it up, depending on what day of the month, those could be really different scores. It could be a really rosy picture to your Equifax, right? But then it could be, maybe you just paid all your bills on your credit card, you know, on the date that it sends it to the other one. So it's not going to be as rosy of a picture. So credit cards can really cause a lot of monthly fluctuating in your scores. And it really does depend on what day of the month they report. So like Chris said, in the mortgage FICO scoring model, there are 5 sections here. You can see payment history is the largest percentage. So we're just going to jump in and talk about that, what that means right now. So 35% of your score is based on everything that you're currently making payments on right now. All of your installment accounts and all of your revolving accounts. Are you kind of familiar with the difference between the installment and revolving, if we use those words? Yeah, okay. So all your credit cards, your student loan, your car loan, your mortgage, your boat loan, anything like that is calculated here, okay? This is also where all of the negative information gets calculated. So any late payments, collections, charge-offs, all of that is collected in this 35% section. It's really important here to know what months of review means. So every time you make a payment on something, you're increasing, kind of ticking up that number months of review. When you look at a mortgage credit report, you can see that. So like if you have a car loan, every month when you make your payment, that months of review gets larger and larger. 1, 2, 3, 4, 5, 6, 7, 8 months of payments, right? Until all the way to the very end. So the larger that number, the months of review is, the more that account benefits your credit score, okay? So with an installment loan, you have to make a payment every month to, you know, according to your agreement, right? But with a credit card, you may or may not have activity on that account every month, right? You may you know, pay it off and then not use it for a while, right? Maybe you just use it for a vacation or Christmas presents or, you know, just in case, right? So to help those accounts benefit your credit score, it would be good to have a little bit of a regular kind of trickle of a charge, like what we say, like maybe your toll bill or your Netflix account on some of those cards that you aren't using will help increase that month of review and help that account benefit your score.
So
and then,
can I ask you?
Yeah, go ahead.
So is it better than to recommend, if you're not, for people, if they're not going to be using a credit card, just go ahead and close that credit card? Or is that?
Not really. No. In fact, when we talk about later, when we talk about payment history, and I'm sorry, not payment history, but length of history, we'll see why that's important. So the answer is it depends. If it, you know, if you close something down, you lose all of that history. In order to kind of maximize your score, you need length of history. So it is okay to keep it open. It's better than just, you know, just to use it a little bit every now and then. Okay.
But if you're not going to use
it. If you're not going to use it, I'll let Chris jump in on that.
You know, I'll tell you a really good story when we get to length of credit history.
I'm sorry.
No, you're fine. I saved that story for then, and it makes a lot more sense. But the one thing I think to note about the model that you see here is everything kind of works together and separately at the same time. But you have to know that maybe you can help yourself in this section by doing this, but you can hurt yourself in this section over here. And you have to kind of understand, well, which is going to outweigh each other. So there are cases where closing down credit cards could make sense because it might help you, you know, here, but it might also hurt you over here. But in some cases, it could hurt you so much that you'll end up dropping your credit scores. So let's talk a little bit about credit cards. The first thing.
Real quick, I add one more thing, Chris.
Okay.
Yeah, I didn't really talk about when you pay off an installment account, just back here.
Okay.
So it's really important, you know, when somebody gets pre-approved and the loan officer says, don't pay off and close anything, right? And well, the reason why is if you've ever maybe experienced, you know, paying off your car note or your student loan, and then that account closes, it drops from this section. So it's not helping your credit score to, to grow like it was before. So that's why loan officers will say, don't close anything, don't pay it off. Although it's this great financial achievement, to make that last car payment, right? You get so excited about the pay raise of, woohoo, no more car payment. But it's important for how your score is benefiting from that, right here, to have that account. So that's just kind of good to know that even though, you've made that great accomplishment of paying it off, it's not going to benefit your score because it's about the activity, the current activity. So, okay, sorry.
Yeah. Okay, so let's talk a little bit about credit cards, utilization, amounts owed. So 30% of your section is about your revolving accounts. And the first thing you need to kind of, understand is if you cross this section out, well, you're left with 70% of the pie. Okay, so this part being the 70%, and so that. But if you're only getting 70% of your credit score, well, that's like ordering a pizza and and then delivering it and dropping it off in your porch and running away. So you don't you stay 6 feet apart, but you open it up and hey, there's 2 slices missing. So it would be kind of sad if that happened. Well, it's the same thing when you don't have a credit card. So I always point that point out first. And we're going to talk more later on about building credit, but I did want to point that out here so you see that and the importance of having a credit card. So let's talk about credit cards real quick here and the utilization and how it kind of scores. And then I'll kind of bleed a little bit into the length of credit history stuff to answer your question. And then I'll turn that section over to Susan for the rest of it. But utilization is simply the percentage of how much you've spent on that credit card. So let's say you have $1,000 credit limit card and you go out and buy a $900 set of tires. Well, you're utilizing 90% of that card. Well, at 90%, you're also losing 90% of the points you could potentially be earning towards your credit score. But if you pay that same card down to $300, you're now utilizing 30% of it. And at 30%, you're only losing 10% of the points that you could potentially be earning towards your credit score. And the word potential is very important here because everything is going to weigh differently based on the other factors that happen within the model. So one card could weigh more than another card based off of several different factors from other parts of the model. But that is what's going to determine that how much it scores, and then the percentage off of it has to do with the utilization. And to kind of illustrate a point here that I talk about in regards to illustrate utilization and the balances, every card kind of scores in a silo. But there is an overall utilization score, but it's not nearly as heavily weighted as the individual one per card. So the story I always tell is a client of mine that had 4 credit cards on his credit report. 3 of them were like small store cards, like $300-400. All of them were maxed out. But then he had one card that was like a $25,000 limit credit card, Bank of America card, had like $200 on there. And it was a joint card. And I asked him, I was like, well, what's going on with that one? He's like, well, that's a card that my mom and I have because we own a business together. And I was like, okay, well, can you write checks against it? And he's like, yes. I was like, well, what I want you to do is write a check to these other credit card companies, paying off all those balances, but leaving like, say, $10 on there. And he did that. So his overall, debt on his revolving did not change, but what changed was the utilization percentage on those 3 cards. And his scores went up over 60 points just by doing that alone. And that actually got him the loan just by doing that because he was about 50 points shy. So that was just kind of something I saw right away that I knew like, okay, this is something that can help him right away through what we call credit coaching. So we do credit coaching with clients to coach them on things that they should be doing. And that's just an example right there. So, but it's also an illustration point so you can see how credit cards are actually scored. Okay. And a lot of times people will say, well, what's their best percentage? And there is the depends answer comes up. because everybody is different and their situation is different. Sometimes if somebody is maxed out, the answer might be just getting it down to 75% is going to help your credit score. But in other people, it's like, well, in general, we try to tell our clients to pay it down to 20% or less. But if you are going to pay it off all the way, we tell them to leave like say $5 or $10 on there. Okay. So does that make sense as far as the utilization on the cards is concerned? Now, if you're not using a card, well, I'm going to bleed a little bit into the length of history section here, so you can, you know, so you can kind of understand, you know, or answer your question really, in that if you take a card, and maybe I can tell a story on this one too, is I had one of my loan officers out in Marble Falls that called me and said, well, actually, no, I was giving a presentation to a loan officer in Marble Falls, and I was talking about this section right here and talking about closing credit cards. And I said in there, I was like, you know, I was like, sometimes you can actually hurt yourself by closing your credit card. She's like, wait a second, I got to make a phone call. She picked up the phone, called somebody and said, hey, you know, don't do what you're about to do. So what this guy was about to do is he had like 5 credit cards on there that were pretty old. And he had been, you know, through his church, taking the Dave Ramsey program, which told him to pay all his cards off and then close them down. And these cards had been, you know, had been opened up for the past 15 or 20 years. He's like, well, I'm not going to use it anymore. So I'm going to pay him off. I'm going to follow Dave Ramsey. That's what my church is telling me to do. That's what I'm going to do. And stopped him right before he was heading to the mailbox with checks in the mail and letters saying to close them, saying, hey, I got this credit guy in here telling me you're going to trash your credit score if you do this. And the reason why is because if you close down a card that's really old, you can hurt yourself in this section right here, which is length of credit history. It's an average of your open and active credit. So the answer of should you close down a card if you're not using it? Well, it depends. And we will talk to clients all the time about closing down certain credit cards, but it's all depends on how it's going to impact it in the model and other places. And usually if it's a card that's much older, we'll tell people do not close that card. If it's a card that's newer, we'll tell people, yeah, you can go ahead and close that one down because you have these other ones to back it up. Does that answer your question?
Yes.
Yeah, hopefully probably more info than you wanted to use.
Because, you know, at the moment, well, there are credit card companies that are offering mega points, and there are, hold on, sorry. If you opened a new credit card, and there are some that are charging annual fees, and there are, you know, you look at how the criteria on them and you think, well, you might not have had it a long time. Is it okay to close it without having your credit score penalized?
So your question is there a way to close it without having your credit score penalized?
Yeah.
So if you're
some that are not that old.
Yeah.
Just because you don't want to pay their annual fees.
Yeah. What I'll tell people is, you know, let's say they have a, you know, whatever, Frontier Airlines card and they don't fly Frontier anymore at all. And that card's been, and they, you know, they pay a $99 annual fee and they don't want to pay it, but that card happens to be 20 years old. And then the other 2 cards they have are, you know, 2 years old each. I was like, okay, you can close that, but you're going to, and you can, you know, you can choose not to pay the $99, but you're probably going to see your score go down 100 points plus. And
wow.
So hopefully people will then realize like, well, maybe it's worth paying that $99. And I'll throw this in there, and this is something I do not advocate, but there are actually people that pay thousands of dollars to be put on credit cards as what's called an authorized user. It's very unethical in my opinion, and I never recommend clients to do that, but that is out there. So I'm like, well, if some people would spend thousands of dollars to get put on there, why just not keep yours and spend $100, you know, that for that year to do it? Because you know what, it's your card, keep it open and spend the $100. It's like you're spending money to help raise your credit score, and in the end, you will recoup that money back in interest rates and insurance and other things that are boosting your credit scores up. So you'll definitely recoup that money back if you're paying $99 to stay on a card that's really old. So sometimes people will make financial decisions that don't always equate to credit decisions. Okay.
Thank you.
Yep.
Yeah, sometimes a customer service decision, right? Like I don't like this card. I don't like the way they do their business, and I'm gonna close it down, right? I have this new shiny one, it has better points, better interest rate, and
Right.
so that can really that emotional decision can really impact you. And the big thing here is that you need 25 years of average credit history to max out this section. And the credit scores that we see that are the 800 plus credit scores have accounts that are older, and if you think of a mortgage, that probably, that may not be your oldest trade line. You may have a credit card that would be older than your mortgage, right? You may have a Sears card, or BP gas card or something like that, right? That could outlive, or American Express account that could outlive some of your oldest installment loans. So it can be important to maintain those older accounts for that reason, because it really does help grow your credit score here. An understanding of a thin credit file versus a thick credit file is important. So the fewer things that are reporting on your credit, the more you're going to be impacted when you open up something new. And there are times when we need to access our credit, when we really need to open a new account, like a care credit account, or for remodeling, or transmission blows out or whatever. Kids are expensive, so having a few more things that are reporting on your credit report, you're going to minimize the hit that you take in the length of history when you open up something new, right? By adding a 0 to the math there, and do the average. So, and like Chris was talking about, it's really important to understand that when you're closing down accounts, that you could severely impact this section here. So if you're closing down your newest account, right, you're going to increase the average. If you're closing down your oldest account, you're going to lower the average. So it's all about that. Okay.
Mm-hmm.
Good. So Chris, let's move on and talk about types of credit.
Yep. Okay. So the next two sections here are both 10% of your score, and we're going to talk about types of credit and then new credit. Now and this really kind of plays into also what I was talking about, is you have all these different models and the different pieces of the model, and how doing things here can impact it elsewhere. And this is one of them where, ideally you'd want to see 3 revolving accounts to 1 installment account. But that doesn't necessarily mean that if you have 3 revolving accounts and no installment accounts, that going out and opening up an installment account, like buying a car just to help your credit score, would actually help your credit score, because you might end up negatively impacting your length of credit history by lowering your length of credit history by doing something like that. So again, it's one of those things where, yes, that is the ideal mix of credit here, but it could impact you in other parts of the model, to your detriment, to your overall detriment. So that's why things have to be kind of weighed when we give advice and things like that. And it's not as simple as just, this. It's not super straightforward. You have to kind of know and understand the different pieces of it and how it would all impact your score. But the one thing that can have is, if you have too many of a certain type of account, that's where it can really impact your score negatively. So, for example, let's say you have too many credit cards. We had a client, and I tell this story all the time, and in Dallas, and I like to pick on Dallas every once in a while, but since I'm from Houston. But I had this client, she had 25 store cards, and they were all open and active and paying on time. And I was like, do you live near the Galleria by chance? And she's like, yeah, how'd you know? I'm like, I don't know, just a thought. but because she loved to shop, and so that um, but she actually, when I looked at the mortgage credit report, and the mortgage credit report will actually show you on there what are called reason codes, which are reasons why the score is not perfect. And everyone's going to have them no matter what. Some kind of reason code on there. Even the credit scores over 800 are going to have some kind of reason code on there. But in her case, one of them was too many open store accounts or retail accounts. And so that was actually counting against her credit score. So, um, and kind of talking about what you were talking about before, closing credit cards, this is an example of where I advised her to close some credit cards. So we put together a plan where I looked at the credit history of all of them, and we chose like probably 7 or 8 of the 25 that she had that were the
Wow.
oldest. And then I told her to go ahead and pay off the other ones and close those ones down. Now, some of them are actually fairly new, and the ones that were fairly new, I actually told her, well, keep them for 6 months, keep the activity on them for 6 months, meaning show activity for 6 months and then close them down. And that's a kind of a weird thing where it goes back to the payment history section where we talk about the months reviewed. You never want to see
Mhm.
less than 6 months reviewed on something. And the reason for that is there's another reason code that can pop up, and we'll talk about that one in the next section. Again, you notice how I'm talking about all these different sections and how they kind of interact, which is factor code 14, which states that length of time since account has been established. And they want to see 3 or 4 payments made on an account. And if they're not, then that code will be on there. And I've actually seen it where people have closed down an account too early, and then that factor code 14 stays on their credit report as a reason why the scores are lower. So it's actually something that's a detriment to the score because it never kind of got past that 3 or 4 month threshold. I'd say 6 months just to be on the safe side. Hey, let's get 6 months reviewed on that account
So,
before you close it
so
down.
how long would something live on an account? So you close it and say you're within, whatever could be less than 6 months or whatever. How long would that live on someone's account?
Something like that, it would drop off, but technically speaking, it would kind of be part of the account for 10 years because it's a positive account and how it would weigh into it. But
Wow.
honestly, it it probably wouldn't affect the credit score for 10 years. It would probably only affect the
Yeah.
credit score for about 2. And after that, it would technically be something that would be tagged to the account, but it would never be an impact on the score. Because usually after 2 years, these kind of things slide so far down as far as the impact on the credit score. But I could see a scenario where if your credit score was so good and other factors, your credit scores were so good, it could be the difference between you being an 832 and being an 831. It could like, oh, I have an 831, but if that wasn't on there, I might be an 832, something like that. It's something that would probably happen as you go up the scale, where it gets more and more picky, really. So it would something that would probably stay in the algorithm, but you would not see an impact in the score at all. So, um, but positive items stay on your credit report for 10 years, and that's why I said 10 years. Negative items, like collections and late payments and stuff like that, and we'll talk about those later, stay on your credit report for 7 years, and there's some other differences with that too. So, but the next section here is new credit. This is going to be, there's 2 things that impact your credit score here. One is anytime you open up a new account, you're going to lose points initially. Just talked about that, factor code 14. From the mortgage perspective, anytime you open a new account, your scores drop, but you see those scores come back up. Like I said, after you make about 3 to 4 payments on it, you see those scores come to back up. But why do you lose points there? That's because the first 90 days of any loan has the highest rate of default across any loan. Okay. I think in the mortgage industry, like 40% of all defaults happen in the first 90 days. So that's why it's kind of factored into the actual credit model that you see a score decrease, and it could be sometimes as much as 20 to 30 points. So, like, talked to a client this week who is trying to buy a home, wants to buy a home quickly. She's very close in her credit scores, but then she also said she was paying off her car, and since now it's paid off, she's kind of itching to buy another one, right? She doesn't need another one, she's just itching to buy one. So I said, well, let's hold off on that before you go off and buy that, because if you buy that car, it might keep you from getting into the home. And what's more important to you, the car or the home? She's like, oh, the home. I'm like, all right, why don't you get in the home, have your first, Zoom meeting, happy hour, or whatever, and then you can, go and buy that car. So that again, these are kind of like, financial decisions, things that you want. But I've had clients, come to me before that are trying to buy a home, and they get in an accident, and they total their car, and like, well, Chris, can I buy a car? Am I okay to buy a car? And I'm like, well, no, but you need a car. You got to get to work, right? Yeah. Okay. Well, you got to do what you got to do. Life happens. There's nothing you can do about it. And that might mean that, it sets you back a little bit. I don't know what to tell you. It's a bad break, but, it's something that you definitely need to think about. And I'm sure loan officers go through this all the time, where they don't have that big truck payment on there. Then all of a sudden they decide to go out and get an F-350 King Ranch, and all of a sudden now there's $1,000 truck payment on there, and they show up at closing. Hey, I'm ready to close on my house. I'm like, wait a second, where'd that car come from? Oh, I just bought it a week ago. We can't close because your DTI, you're 2 percentage points off, and now that $1,000 payment is going to put you over. So those are kind of things that are more DTI related, but can certainly hurt you. But it would certainly hurt the credit score if done earlier in the process. Lauri, did you want to add anything into that? I'm sure you probably have some stories on people doing things like that, buying furniture and appliances.
Oh yeah, people do that. We actually have a letter that I send out, a do's and don'ts, and that's one of the don'ts.
Yeah.
Is don't buy anything without talking to us. Actually, that kind of reminds me of something funny. I'm in part of a mortgage club on Facebook, and somebody was saying they posted a text from a client that said can I not buy anything? And they were trying to explain the process. She was like, but I really need some alcohol. And so a loan officer was like, oh yeah, you can go buy alcohol, just pay cash.
Yeah, just pay cash.
Cash
or debit card.
Yeah, it's like right now I think everybody needs alcohol. So yeah, you can buy stuff, just pay cash. That's our whole point. We don't want to cause the inquiry, number one, and number two, we don't want to see the debt. So
yeah, does Total Wine have a credit card? I don't know.
Yeah, don't use your credit card, just pay cash.
Yeah. So the next thing that impacts your credit score in this section is inquiries, and it's probably one of the most misunderstood things in the mortgage industry.
Take your call. We look forward to speaking with you.
Okay, so
what's that?
Oh, that was hold music or something. But let's talk first about inquiries, hard versus soft. A hard inquiry is whenever you apply for money or credit. That's where you're going to see your scores drop from that hard inquiry. Okay, so when you apply for a loan, to get a mortgage, and yet actually before it goes over to underwriting, they have to do what's called a hard pull to see, are you eligible to buy, a house? If you go apply for a car, you want to see, are you eligible to buy a car, right? So it's a hard inquiry. It impacts your credit score negatively. A soft pull is a review pull. So a review pull is like, anytime, if one of your current creditors, they have the ability to review your credit at any time for different reasons, and that is no negative impact to your credit score. But then probably the most commonly used review pull is your credit monitoring sites is a review pull, and there's no negative impact to your credit score. So, but I think one of the biggest confusion that comes in with inquiries is shopping windows, and do shopping windows exist, and what is a shopping window? Tina, have you heard of the term shopping window before?
No, I don't know what it is.
Yeah. So a shopping window theoretically is that when you go out and apply for a loan, let's say you go to a car dealership, let's say you go to 6 of them in a weekend, and they all pull your credit. Theoretically, you're shopping for a car. So those 6 credit pulls, or however many that come from your shopping experience, buying a car, all show up as one. That's theoretically how it works. Same thing would happen in the mortgage industry. However many you apply for in that given period of time would all count as one. Now, depending on the algorithm, it could be 14 or 45-day window that's being used. So, but the reason why I stress the word theoretically is because it doesn't always work out the way it's supposed to. And the reason why is because the way the information gets reported to the credit bureaus about an inquiry. And I see it all the time, actually, when, because all of our clients that are in, we have them sign up with Identity IQ, and most mortgage credit reports don't show this information, but Identity IQ and a lot of credit monitoring companies will. Well, they'll show the type of credit pull on there. And it'll show usually industry or type is what it says. And if it's a mortgage pull, it'll say mortgage. If it's an auto pull, it'll say auto. But if it's bank or financial, it could say bank, financial, miscellaneous, or other. Well, bank, financial, miscellaneous, and other does not fall into any kind of shopping window. But auto and mortgage does. So does education. So the story I always tell about this is I had a loan officer that came to me and said, "Hey, Chris, I got 2 credit reports here. One, this is the one before, and this is the one where this guy's score dropped 35 points. All he did was bought one car from one car dealership financed by one bank, Ally Financial. So he's like, can you tell me why my client's score dropped 35 points? Does one inquiry, count against you 35 points? Because he was told that even though he went there, they did what was called shotgunning, where they shotgun the information out to all these banks to get back the best rate. And by doing that, it came back with, the best rate, which was Ally Financial. But he was told, don't worry about it. They all count as one anyways. Okay. Because you have a shopping window. I was like, oh, okay, yeah, go ahead and shotgun it out there. Get me the best rate. But in reality, what happened is of those 14, 4 of them showed up as auto and the other 10 showed up as financial. This mortgage credit report happened to show the type on there. So I explained to him, I was like, well, the reason why is because these 10 that show up as financial all count individually. The other 4 are auto, they count as one. Even Ally Financial, the place where he got the car through, showed up as financial. Okay. So he essentially had 11 hits against his credit report, and each inquiry is about 3 to 5 points on average against your credit score. So 11, into 35 is a little over 3, right? So that's, kind of hits that average pretty close. So that's why his scores dropped 35 points as a result. And usually people ask me, hey, well, what can be done about that? And, it's something that we can certainly challenge, and we do challenge, is the type of inquiry that's on there and that the inquiry is incorrect. And, there's ways to get that removed as a result. But how does it get fixed on the front end of it? Well, I don't quite know the answer because I think it's above my pay grade from a standpoint of how that information gets reported, but I see it all the time. And I honestly don't think that banks are really made aware of it when it gets sent. But I think, like with mortgage companies, a mortgage company is a mortgage company. And even banks like Wells Fargo, Chase, and even, Plains Capital have their own mortgage division, right? Plains Capital's mortgage division is prime lending.
Right.
So those all get coded as mortgage when they go. But when you go to buy a car, a lot of times, especially like with credit unions, I mean, they're all mixed together. They're smaller.
Mhm.
They probably single thread that pull to the credit bureaus to get back the information. So that's a theory. I don't know that for 100%. Probably a pretty good theory from just, years of looking at it as to, why that is. So that's something just to kind of be aware of, especially when you're having a client going to multiple lenders. One thing I have heard negative stuff about in the mortgage industry is having people going to Lending Tree. That's where I think the biggest problem comes in the mortgage industry, is when they go to Lending Tree, which is the essential equivalent of shotgunning for a mortgage, where they're going to shotgun your information out to all these different lenders. They're all going to pull your credit report, and not all of them end up coming back as, mortgage pulls. And that's where I have seen people's scores drop as a result of that. So,
What about Chris? What about credit unions as far as as far as getting, because several of the credit unions in our area do mortgage lending. So if they pull, do you think that's coded as a mortgage, or that's just an overall financial institution?
My guess is it would probably show up as financial. That would be my guess.
Okay, that's interesting to know, because sometimes very rarely, but I'll have to send them to a credit union for something that's maybe something they need that's internal. So that's good to know, that I can warn them that might drop your score a little bit.
Yeah, it's one of those things. It's not that going there is going to drop your score, but if you're shopping around and you're like, well, I'm going to go to Security National, I'm going to go to University Federal Credit Union, I'm going to go to Navy Federal Credit Union. I'm going to go to all these different credit unions.
Right.
And I'm going to go to Prime Lending, and I'm going to go to my bank Chase and have them all pull my credit and see, what's the best deal out there. That's where I think you can get into trouble. But if they come to you and you're like, well, you're not able to do the loan, and that that local credit union can, that's a little different, because you're talking about one pull, two pulls.
Right.
And like I said, there were about 3 to 5 points on average. There's a 30-day kind of buffer zone. So a lot of times, if you can get it
Okay.
done within 30 days, then it's not, a big problem. You probably won't see that extra hit show up against you as a result. So,
Okay. Well, that's good. Cool.
yeah. Okay. So we're going to take a little break. This is kind of the part where Trek wants us to take a break every hour. So I know we got started kind of late. So let's just take like 5 minutes, and then we'll come back and we'll get on. So we'll get started at a little bit before 1:20 or 2:20. Yeah, 2:20. So.
Okay.
Okay.
Okay, great.
Cool.
Yeah, thank you.
Check my.
Okay. We'll go ahead and get started back here again.
All right.
I think this is where Susan, we'll wait for Susan. I think she does this part here.
Okay.
Hey.
Okay.
So let's talk about building credit. I know that realtors probably have an opportunity to talk, especially to first-time home buyers, about this kind of thing. What does it take to build the credit that you need for improving your credit score? That what's going to look best in a mortgage pool. So, like we talked about earlier when we talked about types of credit, so it's ideal to have 3 revolving accounts and 1 installment. That's the ideal picture, okay? So that balance is kind of what we're going for, all right? And notice that kind of gets you a little bit more depth of credit by having at least those 4 accounts, right? So there are 2 different main types of revolving accounts: unsecured or secured. So an unsecured credit card is one that you qualify for based on your credit score and your income, right? But if you're starting from ground zero, if you don't really have a credit score, you can't get that kind of a credit card, right? So how do you get that if you don't have a credit score? So a secured card can be a way to get one, okay? Now we recommend this one called Open Sky Visa. And if you're looking at the packet that we emailed out, there's the actual link, the website link there, if you'd like to save that or refer that. But even if you just Google Open Sky Visa, you'll find their website. The reason why we like to recommend them, first of all, they don't pull credit. So you can have no score or a really low score, like a 400 credit score, and still qualify for this as long as you have a job and a bank account, okay? And you can do a minimum $200 security deposit, and then they'll issue you a credit card for the amount of that deposit. The deposit stays in their savings account, and then you spend and pay on that credit card, okay? Some other good things about this account too, it reports to all 3 bureaus, which is really important as far as trying to improve that mid score. If you get something that's only reporting to 1 or 2, it's not as overall helpful. And their fees are pretty reasonable. It's a 18-ish% interest rate and like a $35 annual fee. So there are probably some unsecured cards that have higher expenses than this one. My almost 22-year-old daughter, she is 22. Oh my gosh. Just got just got one and has been using it and has really helped to benefit her credit score. So it does work. And we just found them by going to credit card.
Oh, I'm sorry. Is that what they call the what's that called? Self-lender? Is that what that's called? Susan, I can't remember what that's called.
There's some other programs like that where you are actually borrowing from yourself and then and it's going into savings, but then that's a little bit different thing. I know there are some banks and some other programs that are like that. But this is an actual, credit card that you'll get, to go out and spend, that kind of thing.
Okay.
So it works a little bit differently.
Okay.
Now, there's a point of clarification to make here too. There are a lot of other secured card programs out there that do pull credit and do have minimum credit scores. Like Capital One has a good one, but it has a minimum credit score. Lots of banks and credit unions offer them too. I know Discover Card has one, but you've got to have at least, like a upper 5, low 600 credit score. So that's why we recommend Open Sky Visa as the step one. And then once that's used for a few months and then the scores are kind of coming, up, then it's a good point at that time to look at a different unsecured card that would have a credit score minimum. So those are some things to think about there. Of course, installment loans can be a great way to build credit. It's kind of like the chicken and the egg here. How are you going to get at that? But in that sense, a student loan could potentially be something that could really help to build a young person's by making payments on that student loan, because they're going to get approved for that, and it's taken out responsibly, and they make the payments. It can really help to build credit score. There are some other types of self-reporting that are out there. One of them is rental self-reporting. We recommend Rock the Score, and there's a link for Rock the Score in that packet. So Rock the Score, what they do is they'll take a rental agreement from someone, and then they'll monitor it monthly to report those ongoing, residential rental report payments as a trade line to Equifax and TransUnion, okay? Not to Experian, but to Equifax and TransUnion. So it could potentially be a way to give someone some open activity on their credit report. There's also utility self-reporting through Experian Boost, and there's been a lot of press about this here lately. They have commercials, a guy says, hey, I just raised my credit score 8 points by signing up with Experian Boost. The catch is that it raises the Experian score only, and not your, does not put that data out to all three bureaus. So there's a catch there. And we're a little cautious about recommending it, because when they do that, so Experian scans their bank account for utility payments, and then it reports it as a trade line, right? So let's imagine you've got a $250 a month utility payment, right? And then all of a sudden that drops onto your credit report as an open active account, right? Now, Lauri has to put it in the debt bucket, right? Because it's on the credit report.
Yeah, I don't like that thing.
Right? And it could affect the DTI in underwriting. So whereas normally they're not looking at utility payments toward the DTI, right? Ongoing. So that we're cautious to recommend it. It may not be the best thing. In fact, Chris has had loan officers say that they've actually had to get that data removed from a credit report in order to move forward, that it was hurting underwriting more than it was, the credit score, and they wanted to do some other things to help build activity. So just
that, and I don't want Experian knowing every freaking thing about me.
Yeah.
Right?
Privacy issue. Yeah.
Right?
Yeah.
So anyway, I would proceed with caution on that. And just the reason we mention it is because it's just out there in the media so much. I think people see it as one of those things that, hey, I can do this myself. It's not all that it's cracked up to be. So, okay. Now moving forward, we're going to talk a little bit about, thanks, Chris, credit monitoring. Okay, I can continue to talk here for a little bit. So one of the reasons we really recommend credit monitoring on a regular basis is that 70% of reports have some kind of error on them. Okay, that's a lot. 7 out of 10. So by monitoring your credit, you're going to get, early warnings of these changes. And you may have sounded like earlier we were talking about, Credit Karma was not all that it's cracked up to be. But if you're tracking it every month and you can see the trends of it going up and going down, you're going to be ahead of things that might be a problem on your credit report. So free sites like Credit Karma are one way to go, and they're pretty good. Credit cards and banks often include, credit score monitoring as an add-on feature to their account, right? But Identity IQ is the one that we recommend. In fact, all of our clients actually are enrolled in this plan. because it's a very thorough 3-bureau credit report, just like a mortgage credit report is, with information there. We get account numbers, payment history for the last 2 years, 2 years worth of inquiries, plus their services include fraud protection insurance, kind of really high end, like some of the other ones that are out there. But at that link right there, the creditscorehawk.com, you can get their services for $10 off a month. I think it's $19.99. So they're just a good partner for us and another way for people to monitor their credit. So, okay. All right.
One thing I wanted to add to that, because Lauri had a question on, why use a site like Identity IQ that uses Vantage versus one that uses FICO, and are there ones that show FICO scores? So myfico.com does show a myriad of different FICO scores, including a mortgage score, but it's still not going to be the same mortgage score that you would pull, but it usually be pretty close. It's within a point or two. The reason why we use Identity IQ and not myFICO, number one is because, and I think a lot of it is cost. So we partner with Identity IQ. So the client pays $20 a month. We kind of, bake that into the score that we charge the clients. And then myFICO charges $30 a month. But myFICO, you're not able to pull a new credit report. I think it's like once every 6 months, or maybe even it's once a year, to pull a whole new credit report. It monitors it.
Okay.
But, so you're paying $30 a month, and you see an update in scores, but you can't necessarily see an update in all of the information. And that's what's important to us. Whereas Identity IQ allows you to pull a new report every 35 days. And you can pull one through myFICO, but you got to pay $59.99. So for each time you pull that new full credit report, you got to drop $60 to do it. So it's a lot of money. And so what we do is we kind of monitor that using Identity IQ, knowing that, hey, there's going to be about a 20 to 30 point delta there, typically higher. And if it's something where it's so nitpicky and where we want to, know a little bit more data, then we might have a client go out and spend $30 and, pay for 1 month of myFICO just to see what that mortgage credit score shows. But a lot of times, I'll be honest with you, since I've been doing this so long, I can look at this. The lender says, I need a 640. I'm looking at their scores and everything that's on there, and they're like at a 676 on what we're seeing. I'll say, hey, let's go ahead and have that mortgage pull done. And a lot of times, yes, we're over the target. So, there are times where I'll look at the credit report and I'll say, that 676 seems kind of fishy. It just doesn't make sense that their credit score would be that high with the number of collections and other stuff that they have on there. So I might be hesitant on that. That doesn't happen that often. A lot of times if those scores are that high, I know like, hey, we're probably over the target. Let's go ahead and have that mortgage pulled done. And I'd say I'm about 90%, on that. So, and also Identity IQ does, full disclosure, does integrate in with our software. So it does make it easier for us to, monitor someone's progress and stuff while they're in the program. But, and then Identity IQ, and I don't know if myFICO does this, Identity IQ also gives you $1 million of identity theft insurance. So if someone steals your identity, they'll cover you up to $1 million to get that fixed. So, much like
kind of like LifeLock does.
Yeah.
Is it like LifeLock?
Yeah. So it's kind of similar to that.
Okay.
Yeah, and they're really good.
And does it work the opposite? Oh, I'm sorry.
Go ahead. What was your question?
Oh, I was gonna say, does it work the opposite way? Like if I pull somebody's credit and they're at a 580 and I'm sending them to you, do you re-pull it off the Identity IQ and then you see their scores like a 530, or how does that work?
No, it's like if yours is a 580, theirs is probably going to show like a 600 to a 610, somewhere around there on Identity IQ.
Oh, it's going to show higher?
Yeah, it's going to show a little bit higher.
Oh, that's right. I'm getting confused. Yeah. The Identity IQ is going to be higher. Okay.
Yeah, so we're going to see a little bit higher scores there.
Cool.
But there was a couple times just in the past month where it was opposite, where I was like, okay, hey, we're over the target. I think we're good. And they pulled the scores, the mortgage pulled the scores, and the scores were higher than what we had just saw. So like we refreshed on Identity IQ,
Okay.
and it showed like a 623, and then they came back and said, woohoo, Chris, we're at a 653 or 658 or whatever. And I'm like, oh, okay, so it was even higher.
Which right now we need.
Yeah,
Yeah.
exactly. So
Okay, cool.
this was a month ago when things were a little bit different. So
Yeah,
let's talk.
I know. Amazing what a month makes.
Yeah, we're going to kind of talk about identity theft and identity fraud, and then we'll talk about some negative stuff as well. So identity, and we're going to kind of get through this pretty quick, so we can get to some really important things that we need to discuss as part of the course here. So identity theft and identity fraud, there is, we talked about there's 7 out of 10 credit reports have some sort of detrimental error. Most of them are going to be, error related, but some of them can be fraud and theft related. And I think one thing that people get caught up on identity theft and identity fraud, because it is definitely a big problem in our country and in the world, but a lot of times they don't rise to the level of being a problem on your credit. And it's like, it has to be pretty bad for it to rise to that level, meaning someone actually stole your identity and used it and were successful in opening up an account in your name and is reporting negatively on your credit report. And I've definitely seen those, don't get me wrong. There's a loan officer, not going to mention his name, but he's right around the corner from you there, Lauri, in South Houston. But he had somebody opened up a student loan in his name for an online university. And he's like, I've never attended that university. And he's still been going round and round and round with them. And they actually verify the information when he, investigates it, because they had so much of his information, they entered it online. But since, with signing laws and e-signing laws, they e-signed his name, again, fraudulently and illegally. So,
wow.
But, and it was sheer fraud and stuff like that. So these things definitely happen, and it can be a real pain in which, going back to having something like an identity IQ, and there's other places that offer it. A lot of times your homeowner's insurance offers stuff like that. Even my wife, was doing, through her school, they're like, do we need this? And it's like, I think I'm going to sign up for this. I'm like, no, we have identity IQ. We don't need that. It's just redundant, stuff.
Right.
So you can sign up for those kind of, I call them insurance policies, against, fraud and theft on your credit report. But if you don't have them, it can be a real pain. But mail theft is really just someone stealing your mail. Dumpster diving is kind of the same thing, but they're trying to get information by digging through your trash. Shoulder surfing is simply someone looking over your shoulder to steal information. Again, all of this is kind of going to stealing that specific information. Phishing is one that I think leads to such a big problem, is that you get those emails, and I'm getting flooded with them right now, quite honestly, and it's confusing.
Yeah.
I got one saying that my click here because your Amazon Prime account is, of course, it's timely, right, because of COVID, and everyone's got an Amazon Prime account, and it's such a big part of it. So I got an email about Amazon Prime account. The payment didn't go through, so please click here to fix this. And I was like, oh wait, what? I kind of like hovered over it for a second and thought to myself, no. Then I went over to my Amazon app, opened it up, and I'm like, yeah, my payment's not due. I don't pay monthly, I pay annually. It just didn't make sense. But sometimes you just think, and there was one that I don't remember what it was for, and I know I clicked on it. I'm like, crap, what did I just click on? But it made it seem so real and so much like emails that I normally get. It can be really hard. So they're getting really, really good and sophisticated on this. Pretexting is basically when you get information about something in order to use that against them. I think we see this a lot with senior theft. Happened to our mom, something similar where someone called up and said, hey, grandma, I'm in jail. I need some bail money. And she's like, wait, what? And then she called Susan and said, hey, where's Robbie? He's at school. Oh, because I just got a call from someone said they're Robbie, said they're in jail. And it's like, no, that's not him. So, it's a big
Another
problem when
one,
you're trying to do that.
Chris, yeah, here's one that's come up in our community. Someone has hacked or has duplicated something that looks like an email that comes from the pastor at my church.
Hmm.
Oh, wow.
Yeah, and is emailing people in our church, and I don't even know how they've gotten that, with a message saying, I need some help. Can you call, can you message me back here? And if you look real carefully, you can see that it's not church's URL that the email is from. It's from Gmail. It's like Pastor Bobby at Gmail instead of Bobby at church URL, right? But his picture is there, so it would be really easy to see. So they're getting very sophisticated. And my husband just kind of played along with it to see what would happen. But basically, the person is asking for you to buy gift cards, like Amazon gift
I've
cards,
gotten that. Yeah.
cards,
Yeah.
and then scratch off the thing, and
The
then
back
show
of it,
them
yeah.
the back of the card, take a picture. So at that point, he just disconnected. We just wanted to see what would happen. So just really trying and so many ways to separate people from their money. It's unbelievable. Sorry to interrupt.
No, that's
I agree. We take a whole class on that at Prime Lending.
Yeah.
The entire class is dedicated to phishing and that kind of stuff. It's horrible.
Oh, I bet, and phishing kind of leads into, I'm going to skip over one, but wire fraud, which is probably very applicable there with prime lending. And that happened. There was a big problem in Austin.
Well, it's more so with
company,
Shelby. Yeah.
Yeah. In the title world, there's a title company in Austin that actually got shut down as a result of, wire fraud, where it was just an email that was one character off, and the money went to a thief instead of being funded like it was supposed to. So something they have to be really careful of.
So bad.
And ransomware is simply when someone when you do click on one of those phishing links or whatever, a lot of times they can download something that locks up your computer. A big reason why I use a Mac, because some of those things don't happen with Mac. More so they happen with PCs. I actually talked to a guy at GoDaddy.
If your real estate transaction line outside this area, great.
Somebody on hold?
Yeah, I'm just going to mute Shelby there. So the but when you have the well, I talked to a guy at GoDaddy about PCs, and he said, I was like, what do you do to protect your PC? What kind of software do you use? And he's like, well, I just unplug mine. So that was his answer. But so that, kind of, I was like, well, that's all I need to know about, He's like, but even a Mac can get, have issues and have problems, but I don't think you see near the problems with Macs as you do with PCs. Skimmers are, really things that are like gas pumps, where they're trying to steal that credit card information. And I would kind of put in that same category RFID skimming. I've never had one of these cards, but Chase just sent me a new debit card. I was like, okay, cool. Because it's like Disney and it's got like BB-8 on there and you get like Disney rewards. I was like, okay, cool, I'll try this. Well, it's got a little RFID symbol on it. And as soon as I got it, I went on to Amazon. I ordered me these little RFID protectors, because the people walk around with devices. Now, of course, nobody's really walking around each other right now, but back in the day when we could. Was that a cat? That is funny.
Yes. See my cat?
Yeah.
She wants to take the credit class.
Yeah.
She's sorry. I get this every day. She's my coworker now.
Yeah. That reminds me of like Pets View or something. But yeah, they can, just by walking by you, they can, your card is always transmitting. So if you have a little thing that looks like those, little, almost like a Wi-Fi symbol on your card, that you can just tap your card on something, but people can actually steal your card information. So something to be very, very careful of if you happen to have one of those. And if you don't, I spent $5 today on Amazon and just got these little sleeves that you put your card in there, and it actually absorbs the that code that RFID code that goes out there, so people can't skim or get that from you. And then the final thing here is breaches, and that's been a big problem. Equifax, that got breached a few years back, and all these places, you hear them all the time. Such and such place was breached, and basically that's people that just basically crack into a computer system and steal that information. Sometimes it could be millions of people's data. Sometimes it's things just as simple as name and address, but even that, it's amazing just with a name and an address you can get with stuff. I'm like, isn't that stuff in the phone book? I don't know. But back when we had phone books. So but it can certainly, those are things that can certainly be a problem. Susan, you want to talk about identity errors?
So as upset as we get about all that theft stuff, because we probably all had something, happen to us that's fraud related and somehow, but it probably, mostly rose to a financial impact, and it may not have actually shown up on our credit report in some way, but errors are statistically way more common. So if you have, if you just think about all this data rolling around out there, and if there are similarities in especially in highly populated zip codes, like let's think of like 78681 in Round Rock, Texas. Lots of people live there, right? If you've got Jones or Garcia or Smith or Thompson as the last name, you are very likely to have something pop on your credit report just statistically, because of those similarities. That being said, families that have some common names, especially like juniors and seniors, almost always have some kind of cross-reporting, like Mark and Marcus, or juniors, or different middle names but same first and last. That can cause a lot of that. So the last part here that is a little mind-boggling is when your files can actually merge if you have 4 letters in your name that match with 7 out of 9 social security digits. It causes the files to actually merge. And on the credit reports, especially mortgage, it'll say social security mismatch. And we've seen credit reports with that occurring on there. And this is why they don't issue social security numbers consecutive in families any longer. It used to be, way back in the day that mama would go down to the social security office with the birth certificates, and they would be issued consecutively with the kids, right? Which might have been nice for, mom and dad to remember the numbers, but it surely didn't do a whole lot when we put that out there in our computer systems, and they just, allows for those errors. So Chris tells a story about poor Roberto, who had an account on his credit report that he thought was identity theft. It was a credit card that had been used for a long period of time, and he just didn't recognize it at all. But the funny thing was that all of the payments were made on time, and it had kind of a low utilization balance, and it looked like a really good account. And it was probably actually helping poor Roberto, but it actually belonged to a guy named, and turns out they had 8 out of 9 social security digits that were in common, and practically the same first name. So, and poor Robert probably had some negative things on his credit report that belonged to Roberto. So that is just, one example, but about how that could happen. So, all right, I think we're going to move on and talk about some negative things now, especially, this is just kind of a laundry list of the types of negative items that can be on your credit report. And this is where we go to work as credit repair specialists in getting these types of negative items removed. Everything that's on your credit report needs to be complete and verifiable, accurate, and non-obsolete. And so we take an approach where we're challenging the reporting of these negative items. But specifically, we're going to kind of jump in and talk about collections, because this can be understood. Things as far as how it impacts your credit report and how paying collections can impact your score. So I'll let Chris forward that over to the next slide.
So collections, I think, the biggest thing people need to understand on collections is, I kind of say it's like three things to really know. First off, paying a collection does not remove it from your credit report. Okay, and I always go over this with clients so they understand. And in most cases, paying a collection does not raise your credit score. Okay, and then also the third thing, that paying a collection can actually drop your credit score. Now, why is that? So, and that's where we kind of talk about new versus old here. That the newer a collection is, the more it's going to impact your credit score. The older the collection is, the older it's going to impact the credit score. Now, earlier I kind of talked about this big, huge drop off of items. So whenever you have something that hits your credit negatively, it's going to hit you like here, and then it's going to quickly start to slide down a scale as far as its impact on your credit score. So your credit scores will actually go up over time as that negative item ages. And that's the same thing with collections. But what happens when you pay it? Well, that's activity, and the dollar amount doesn't really have anything to do with the impact on the credit score. So what happens is when you renew the activity, it goes back up to where it was. So, we see clients that pay off old collections and their scores drop all the time. And I'm sure Lauri's probably seen things like that as well. But does that mean you should never pay a collection? No, I'm definitely not saying that at all. In fact, there are cases where paying a collection definitely makes sense. And this goes back into the credit coaching part where, we're going to coach the client on what's best for their situation. And it could be that paying the collection makes sense. If we look at a collection like, hey, the date of last activity is a couple months old, because there are times where even though it's a really old collection, the collection agency will update the DLA. And if we send off our investigations and we can't necessarily get it removed and they're in a hurry, then I might say, well, hey, go out there and try to settle it. Here's what you say, here's what you do, here's how you do it. We can't do it for them. We're not a debt settlement company, but we can give them the advice on what to do. So they go out there and they settle it. And when that happens, it makes it easier for us to get it removed in a lot of cases. Now, when we, and Susan kind of talked about this a little bit, but, the Fair Credit Reporting Act states that everything that shows up in your credit report must be accurate, verifiable, complete, and non-obsolete. So we open up investigations, things that we know the creditors and collection agencies are supposed to keep on file, but a lot of times they don't. If they cannot respond within a 30 to 45-day time frame, then by law, that negative information must be removed from the credit report. And a lot of times when we have collections that have been paid and we send off our investigations and they say, well, we already got our money for this. Why are we fighting to keep it on the credit report when we've been paid? So a lot of times they just don't care. So we're able to get items like that removed, quicker. I think the best example is like First Premier credit card. It's one of the more charged off credit cards that we see on our credit report. But we also know that they will fight tooth and nail to keep it on their credit report because that's the best way that they can get paid. They'll usually take a 20 to 30 cents on the dollar settlement. But once they've got their money and they've been paid, they don't care as much. So then we have higher chance, sometimes up to 90% chance of getting it removed after it's been settled and paid. So usually when we're looking through a credit report, we see a charge off on First Premier, we're like, go pay that right now. So now one thing to note about the collection types, all of them will impact your credit score. And you might hear, well, medicals don't count. Yes and no. They do count against your credit score, but they do not count against your debt to income ratio. Okay. Charge-offs are kind of similar in that, and that they don't count charge-offs on DTI, but they definitely impact the credit score. So, but if you're talking of, if you have a cumulative amount of non-medical collections over $2,000, then they have to count 5% of that towards the DTI. Is that correct, Lauri?
Medical, we don't have to count 5% at all.
No,
it's just if it's over, well, it depends on the program. If it's over Yeah, non-medical. Yeah, it's over $1,000 on FHA, then it's a 5%, or you have to satisfy them, or you have to show they're not yours. So yeah, it can be a real pain.
Yeah, for sure. Yeah, it was weird. I actually had one that the loan officer said that they could get the loan through if it showed that the item was in dispute. So,
yeah,
and that usually they
that
have,
is really weird.
And it was a conventional one too. And they said, because usually you have to have the dispute removed, but then because she was saying it wasn't hers, and they said, well, in order for you to prove that it's not yours, you have to show it in dispute. And so, and there was a client of ours, so they said, can you make sure that this shows in dispute? We normally go out of our way to avoid that. So we just sent in more of a verbiage on the letter saying that we are directly disputing this item and it's not mine, please remove it. And then of course the word dispute showed up, because we normally avoid that kind of language.
That's good.
Because disputes can be
stuff you don't want.
In this case, it was like they wanted the word dispute. I was like, well, I know how to do that, and here's how you do it. You do it like the other credit card companies do. So
I know. It's credit's one of those, guilty until proven innocent.
Yeah. So we kind of want to talk about COVID, and this is where I think, we wanted to spend a little bit more time, which is I was trying to get through some of that other stuff so we can talk about this. But all of these, COVID obviously is impacting everything. It's impacting our daily lives. It's impacting our financial institutions. One impact that it's having on credit repair is kind of a positive impact right now, in that because we are sending off our investigations, like we just talked about, somebody has to answer those investigations. And if there's nobody there to answer them, and collection agencies can't just work from home, and a lot of times banks are short-staffed, so they don't have the people to answer these investigations. So we're seeing a lot more deletions and a lot more things coming off because there aren't people there to answer the investigations. So,
interesting.
Yeah, so that's a helpful thing. It's not going to last forever. It's kind of like, we got this short little window while things are, kind of in, a state of craziness. But I think some banks that might be in like South Dakota, places like that, are probably more active than others that are like in Delaware and stuff like that, that are, where they have those. But even if they farm stuff out and it's overseas, then they're still having the same problems. A lot of those, a lot of countries are still in, a stay-at-home order mode. So, but how it's impacting realtors, obviously it's harder to show homes, and there's different rules, and some places are on, lockdown, and they can't go out. Is Houston on a complete stay-at-home lockdown?
Yeah. Houston is. I think Austin is too, right, Tina?
Yeah.
I'm pretty sure it is. I think Austin is more strict than Houston.
I had a buyer just ask me to show him some homes tomorrow in a particular area out at Lakeway. And when I pulled it up, one of the agents had a COVID disclosure and how to show it, and everything required signatures before you venture out. I personally have not wanted to show anything. I didn't want to activate anything because I don't want to see the cumulative days on the market. And, you just never know about people.
Yeah.
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 And I'm finding that in the Houston market too, Chris, with realtors. Like I said, even today, I don't know, it's like everybody's kind of at a standstill, so they're afraid to do anything. It's the weirdest thing I've ever experienced.
Yeah.
It's not like 2008. This is just a totally different situation. I've been doing this for 32 years. I'm just like, wow, this is crazy. It's almost like and it's not just real estate agents, it's everybody. Some people think it's like an extended vacation, so they're not doing anything. And then other people are trying to work as usual, and it's not working. So, and they got kids. I have adult children, so I don't have that issue.
Same here. I have adult children, but I'm in a risk category. So for several reasons. And so I'm nervous about exposure to other people, even with a mask.
Yeah.
This person, I'm still debating whether I'm going to embark on it. Yeah. But I'll tell you, all over the country, I have a friend in Florida. She just sold her house. I could not believe it.
Wow.
Yeah. So it just depends on where you're at.
Yeah.
Austin's a little bit harder hit, I think.
In New Mexico, and that deal fell through because due to job loss everything fell apart and the man didn't qualify.
Right. And we're having those issues too, by the way, just so you know, as a real estate agent, as far as COVID, that's affecting us as far as jobs. So we have to, the day of closing, we have to call the customer and make sure they're still on their job. 48 hours
Right.
before we close, we have to call the business and make sure they're still at their job. So it definitely is affecting us. We've had several where they're not working anymore. Now, if you're furloughed, it's different. We can still do the loan. We just have to, we have a few more things to jump through, a few more hoops, but we can still do it. It just causes issues. That's why communication is so important right now with our customers.
Yeah.
We just have to know where they're at.
Funny.
So.
Yeah.
Funny story about that, because in 2008, right when the meltdown was happening, it was right before I got into credit repair, and and the company that I worked for was VC backed, and they had money that was kind of waiting with Silicon Valley Bank, and we were waiting for our next round of funding. We were a software company, about 45 employees, and had a refi. I was doing a refi, and I was about, 4 or 5 days away from closing. I just had the appraisal done, paid for it, and I had a closing date, everything. And then I got this call saying, "Hey, we have an all hands meeting." I'm like, "Oh, I'm working from home today." I was actually really looking for a job because I saw the writing on the wall.
Yeah.
So he's like, "Oh no, you got to come in." And so I came in, and they're like, "Here's your last paycheck, GTFO." So, and I lost my job that day. And I was just a few days away from closing on a refinance. And I called my lender up, who was a friend of mine from college. And I was like, "So can I still do the refinance if I just got laid off?" He's like, "What? No, you can't do that." I'm like, "Oh my." He's like,
"Yeah, I'm glad he said he couldn't."
But he's like, "Yeah, no, you can't."
Good job.
Yeah.
So it's kind of happening now too. So.
And then I had to switch industries because I went.
It's not good. I'm thinking things will straighten out, but it's not good.
Yeah. So, quick, just a couple of things to point out here: government stimulus and small business. Like Lauri said today, and the PPP is out of money. So hopefully, if you can, you don't have to worry about it with the senators and stuff in Texas. But there's some Senate holdouts that need to get off get their butts in gear and need to vote for the small businesses more money. There's $250 billion sitting on the plate right now that there's certain senators that are holding it up. But if you have friends in other states like New York and California and stuff like that, tell them to call their senators and get their ass in gear and get small businesses some more money, because they ran out of money today. $349 billion. It's crazy.
That's horrible.
And I'm on this thread on Facebook that's got thousands of small business people, and there's hardly any of them have gotten funded. So many of them, 80% of the people on there are all like, I put in my application, haven't heard anything, and I'm one of them. So I put in my application, and haven't heard back from Chase. So, but there's one guy, that's local. He's a mechanic, and he tried to put one in, but his small bank, by the time someone got back to him, he's like, "Oh, well, we're no longer accepting applications." And then when he went to the bigger banks, they said, "Well, if you don't have an account here, we're not accepting your application." So
that's what credit unions are doing too. My husband runs a credit union, so they're not, unless you're in a credit union member, he can't do them. But he has done several for some folks that are members, and those are going okay. So.
Oh, well, that's good. That's good. But Laura, in the mortgage industry, we kind of bleed this into talking about the different programs that, how does the impact of credit on buying a home, the different programs. What are you seeing right now as far as guidelines and credit scores for the different programs, and what's really changed over the past couple weeks?
Well, a lot of things have changed. So FHA, like I was telling you before, 640 minimum credit score for a lot of the lenders like me. Some of them are higher, like Chase Bank. The traditional banks are going to be even higher. Some I've seen 660, I've seen 680. But the only thing FHA has really said is they want 2 months reserves. That's FHA. That's not the lenders. So you have to have 2 months reserves on FHA, which is hard because most of your FHA buyers don't have money. That's the point.
Right.
And then when you do a bond loan, because we do a lot of grant loans too, if you ever need anything, we're still doing the Southeast Texas and the T-Shack. They've come out and said also 640, and you need 3 months of reserves. So that's always fine. So we're kind of battling. It's like Yeah, exactly. So like, why do you get bond money? You know, so it's just been hard. USDA is similar, VA is the same thing. Now VA, I'm trying to think. Actually, VA has not changed their credit score requirement. They're still 620.
Okay.
So VA is still okay. Conventional has been okay as well. They're still 620. It's really our government loans that we're having the problems with. The rest of them were now jumbo. You can't find a jumbo to save your life, but there are like the funny thing is, and I don't know if Tina's heard of him, but one of my biggest jumbo people is out in Austin. Obviously, his name is Joel, and he works for Prime Lending. And I called him the other day and I'm like, so how are you doing? Because I knew he was impacted because all the jumbo lenders have just folded up. Prime Lending has 2 programs and then there's a couple others that he's got now, but he only has like 4 resources now for jumbo. So that's been our hardest hit, is what they call those is non-QM. Those are the lenders that are falling by the wayside. And all this just has to do with the servicing. It's hard to put in layman's terms, but so it's just supply, demand. We got hit, like I was saying in the beginning, with really low rates and everybody was wanting to refinance and buy. And so everybody we got slammed. We were overwhelmed. And so that just created a big demand problem. And the servicers were like, wait, we can't, they couldn't handle it. So then things started tightening up. Rates were still low. We were still getting hammered. And then COVID hit. And then all of a sudden the credit guidelines tightened up even more. And so these servicers don't want these loans.
Yeah.
So I found out yesterday that Prime Lending is servicing right now 95% of our loans. That's unheard of. So we're just lucky that we have the funds to do it. But we can hold on to that probably, I don't know. We can hold on to it. It's fine. But some of these others, and the reason why the servicers aren't taking them or we're not selling them is because of the cost. You lose like 2 basis points right now. So they don't want to sell them. Of course not. They don't want to lose all that money. So they're going to wait and see. And then they'll see what there'll be probably a mass sell off. But it's been like the rates, like I had a price change earlier. Like it starts off in the morning and everything's going good and then bam, you just get your teeth knocked in. It's like, what the hell? So that's why I tell people, if you want to lock in your rate, let's do it like right now, because I promise you in 10 minutes, you're going to see the market shift. So it's been challenging, really challenging, but we're hanging in there. It's a roller coaster.
Yeah. My wife and I, we just closed on a refinance right like in February. So we kind of got in right, and rates were still low and I know they dropped a little bit, but they've come back up. So, but it was good timing. And, we paid for a point, but we got, less than 3, I think 2.875 for our rate.
Wow.
So,
that's great.
But
yeah, you probably won't get that now.
No, we're locked in. We're good. We're good for a long time. No more refinancing for us.
Yeah.
So,
you're good. Yeah. So it's definitely been challenging, but we're handling it.
Yeah.
Fun time, right?
One of my wife's, one of her best friends, that I think her and her husband, because her husband runs like a basketball sports league type thing. So it's kind of like AAU, but it's, for like all ages, but it's, a basketball program, and they travel the country. Well, obviously his revenue, and he was doing well, he was probably making 20 grand a month or whatever. And all of a sudden it went down to 0. So,
wow,
it's just like that. Everybody's like, cancel, because we can't play. We're not going to pay.
I know. And the other thing I was going to mention to Tina maybe is if you have any customers that are asking about forbearance, and I just posted this too. If you want to, if you go to my Facebook page, which is just Lauri Coppock Prime Lending Home Loans, you can find it. I just posted this really good article about the difference between forbearance, modification, and deferment. But please try and tell your customers, don't do it. If they can make their payment, make your payment. Forbearance is not a great option. It'll come back to bite you. You're gonna, in about 3 months, they're gonna owe $10,000.
I'll probably share that on your page, Lauri, because I've shared kind of similar information.
Yeah, you can share that.
But it's I looked into it. I was like, well, maybe that's something that I'd want to look into, just with everything that's with customers, because we're getting customers canceling right and left. I lost my job, please cancel. We're usually the low man on the totem pole when it comes to those kind of things. So
exactly.
I've looked into everything, but when I looked into it, we're with United Wholesale Mortgage, which is like the largest servicer in the country. And when I went on and downloaded their sheet and looked at it and actually did a post and a little video article about it, was, it's not what it's cracked up to be. Basically, you're going to have a balloon payment due, and it's like, 90 days or whatever over forbearance, but you're either going to have to pay it all when the forbearance is done, or
spread it out over 12 months. Yeah.
Spread it out over 12 months or restructure your loan. So, and none of those.
Well, the problem also is then you can't get a loan then. You can't, if you go into forbearance, even though they're not reporting to credit bureaus, that's the only good saving grace, is I can't give you a loan after that because you were in forbearance. So it's like, well, what's the freaking point? So you can't lower your rate. You can't do anything. It's crazy. So I tell people, I'd rather see, I haate to tell them this, but I'd rather see you not pay something else or defer another payment, or,
like
but just not your mortgage.
Car payments,
I hate to say that.
With that. But if you're going to do it, then I would defer a car payment over, over your mortgage for sure.
A mortgage,
because I think from what I understand with car
it just
payments,
causes problems.
They just, the clock keeps ticking on your interest, and you just put your loan term out that much longer, 3 months longer. But it's something I think that can be dealt with.
Yeah, that's a deferment. Yeah, and mortgages won't defer. Yeah.
And I think that.
I agree.
So you think people go the forbearance route just out of ignorance?
Right. They just don't know. That's why I keep posting stuff. Yeah.
Yeah.
A buddy of mine said
the whole thing is just messed up. Just sad.
A buddy of mine said that he went on with his Chase, and he went into deferment with his Chase, and I was like, I don't know. I take him at his word, but I was like kind of questioning it, and even my other buddy of mine who works for Wells, and he's like, I don't know, dude, you might want to look into that. It might be a forbearance. You might get screwed in the end, but you might want to check in on that. So,
I'm thinking so. I don't think Chase isn't going to be any better than anybody else.
Yeah.
They're probably going to be worse.
Banks are all the same.
Yeah.
I agree.
So Tina, what did you think? Did you get some good information today?
I did. Yeah, thank you. Yeah, it was very interesting. The three of you interacting from different perspectives and experience, and it was great. Thank you.
Yeah,
appreciate it.
We don't know. It's not normally this interactive, but since it's a small group.
Yeah.
And I haven't done this in a while, so I relearned stuff.
I felt guilty, securing the three of you just for me.
You're fine.
Yeah. Thank you. I really appreciate it. And I did like you on Facebook.
Okay.
Oh, good.
it.
Appreciate it.
All right.
And I don't know, is Shelby still there? She couldn't hear. She was trying to talk and she couldn't get in.
Yeah, I muted her because her whole music was on.
Is she muted?
Yeah, Shelby, are you there?
I'm here.
Sorry, yeah, your whole music was on.
You were muted.
So.
Oh, okay.
And
I was trying to interject some stuff on the wire fraud, but it's okay.
Y'all,
it was
sorry.
a great job. It's okay. I learned from it.
Did you learn anything?
I did. I did. Very
that's what I was saying. You're the one that gets affected by the wire fraud more than I do, because I know you guys send out they have on every one of their emails. I make them call about wire. We have to always call about the wire and make sure it's the right people. So
yeah, because I've actually had it happen on one of my files where I guess they intercepted, our wiring instructions, and we have protocols too. We call, before we ever do anything to talk to them about wire fraud. It's all over our emails, and on the email, I told the lady that she would get a discount if she would send in, and it was like $116,000.
Oh my gosh!
Wow.
Yeah, and she believed it, wired it, and then called us about it, and we had no idea, because it didn't come from us. It came from, however they hack in and get it.
Wow.
So what happened?
Wow, that's crazy.
Well, she had to call her bank, and they actually have to file a fraud report.
Oh, wow.
And hopefully get it back. But she may just be out of the money.
Oh my gosh. That is
wow, that's terrible.
And it was devastating, it's devastating. but she didn't call us when she should have. And I'm not saying it's not her fault, but with as much as we preach about it, you always want to call and verify those wiring instructions. It's just like with realtors, when they send us their wiring instructions, we always call and verify.
Mm-hmm.
Yeah, and it's not even just in the real estate industry. It happened in my where I live. This bridge, they're now calling it the $1 million bridge because there was a wire fraud issue where the city government was paying the contractor, and then finally the contractor was like, "We're not going to keep building this bridge because you're not paying." It's like, "What are you talking about? We paid you like $1 million." And they said, "Well, we never got it," and it's because they sent a phishing email about wiring instructions, and it was not the correct one, and so they were wiring the money to the wrong source. And I think,
oh my God,
that and like even
that happened in Manor here locally. They had something similar in Manor.
Yeah, it's
crazy.
It's crazy.
Yeah, it's crazy. And same thing happened at my kid's school with bond money. It was like $500,000 of bond money just disappeared. I think the FBI was able to get 350 of it back, but and I know the FBI is looking into this deal with our town as well. But it's such a big, big thing. I mean, gone are the days of the smash and grabs. Now it's it's sophisticated wire fraud guys that are out there.
Yeah, now it's all right.
Bank robbery is going to be a thing in the past. This makes a lot more money. You can sit in a basement and do this kind of
That's
stuff.
right.
Yep.
Wow.
Well, hey, Lauri, if you have your realtor's license and need credit, just send me your number and I can give you credit.
Oh, I don't. Yeah,
today.
no, I don't have a realtor license. Yeah, no, I can't do that. That's against the law for me.
No, sir, I do not.
No, Shelby probably shouldn't either. No. Yeah, our business, we can't cross.
Well, thank you. I appreciate it. Thank you. Nice to meet all of you.
Oh, and did you give me Tina's, Tina, if I have your cell phone number, I'm going to send you get the door prize. Yay.
Yeah, I forwarded it to you, Lauri. Did you get it?
So I think Chris sent it to me. Yeah, Chris sent it to me. Yeah, so I'll send that to you. I'm going to text you a gift card.
Okay. Yeah.
Thank you.
Great. And then, and you're our door prize winner too. So you'll get a $10 Grubhub gift card.
Highlight of my day. Thank you.
There you go.
Tina, if you have any that you think would appreciate the class, we've got some upcoming classes on our Facebook page. So now that you've liked it, you can find it and share any of our upcoming classes with any colleagues.
Okay, I'll ask a few people if they need some hours and updated information, because financially everything's changing.
Yep.
Minute by minute.
Yeah. No, I learned something new today from Lauri that may have been different from yesterday, that was different from last week. So every day there's new stuff.
Absolutely.
Exactly.
Yeah.
Okay. Well, great, guys. Hey, I appreciate.
Yeah, my other half is the financial advisor, and he's camping out. His office is now the kitchen table, and every day, I mean.
Well, my office got
it's nuts though.
From my wife and her, because she's a 4th grade teacher, and then a part of our living room is where the kids, because we have a 5 and an 8-year-old, and so that's their learning area now for homeschooling. So we have a homeschooling area. My office is now my wife's office, and I'm in another part of the house with a table and a laptop. So
we all make
adapted. Humans adapted.
As long as we stay healthy and we pay our bills.
Okay,
that's right.
All right. Well, thanks, guys. You guys stay safe, stay healthy.
Well,
okay.
Thank you, Chris and Susan.
All right. Thanks, Lauri.
Thank
Thanks,
you.
Shelby.
We will.
Bye.
Bye. Bye.
Bye.